Have you ever wondered how the US stock market actually works? Why do people say things like, the market is up, or Wall Street is crashing? Is it really just a giant casino, or is there a system behind it all? Today, we're going to break it down, step by step. We'll go from how a company sells its very first stock to what happens when you tap that buy button on your phone. By the end of this video, you'll understand what truly moves the US market, who the real players are, and how ordinary people can make or lose a fortune. So, let's start with the absolute basics. What even is a stock? A stock is simply a small piece of ownership in a company. Imagine Apple as a giant pizza. When Apple wants to raise money to grow, it cuts that pizza into millions and millions of tiny slices. Each one of those slices is a share of stock. When you buy one share of Apple, you technically own a tiny, tiny part of the company. If Apple does well and grows bigger, your slice becomes more valuable, and you make a profit. If Apple performs poorly, your slice loses value. It's as simple as that. But here's where it gets interesting. When you buy a share of Apple stock today, you're not actually paying Apple directly. You're buying it from another investor who already owned it and decided to sell. Apple only makes money from its stock the very first time it sells it to the public. This event is called an IPO, or initial public offering. Think of it as the company's big debut on the market. After that, it's just investors like you and me trading those pizza slices back and forth among ourselves. The company has already gotten its money. Now the game is all about the value of those slices. So, where does all this buying and selling happen? In the US, there are two major stock exchanges, the New York Stock Exchange, or NYSE, and the NASDAQ. Think of them as massive digital marketplaces where buyers and sellers from all over the world meet to trade. Every single second, millions of orders are placed. Some are by humans, but honestly, most are placed by super-fast computer algorithms and trading bots. When you click buy on your trading app, your order is zapped through a complex network of brokers, servers, and exchanges, all in a fraction of a second, until it finds a seller willing to match your price. And just like that, your trade is complete. You now own a piece of a company. The price of a stock changes every second, and it's all based on one simple principle: supply and demand. If more people want to buy a stock than sell it, there's high demand, and the price goes up. If more people want to sell than buy, there's high supply and the price drops. It is a constant tug-of-war between buyers and sellers that determines the value of a company AIS stock at any given moment. So, why do stock prices change so wildly every single day? Here's the truth that might surprise you. Most of the daily price swings aren't based on cold, hard logic. They're based on emotion. Investors react to news, rumors, and most of all, fear and greed. If a company reports fantastic profits, everyone gets excited and rushes to buy, pushing the price up. If there's bad news, like a product recall or a global crisis, everyone panics and rushes to sell, causing the price to plummet. That's why you hear phrases like the market crashed. It's not a physical event. It's just thousands or even millions of investors reacting at the same time, creating a powerful chain reaction. This emotional side of trading is why even the smartest experts can lose money. The market isn't always rational. Sometimes it's just plain emotional. So who are the real players controlling this multi-trillion-dollar system? It's not just one group. There are four main players you need to know. First, there are retail investors. That's people like you and me, buying and selling shares from our phones or computers. Second, you have institutional investors. These are the big fish, massive companies like BlackRock, Vanguard, or huge pension funds that manage billions, even trillions of dollars. Their decisions can move the entire market. Third, there are traders and hedge funds. These are often short-term investors who use complex strategies to bet on daily or even hourly price movements. They're trying to make quick profits rather than investing for the long haul. But the fourth player is arguably the most powerful of all, the Federal Reserve, or the Fed. The Fed controls the country's main interest rates. When the Fed changes interest rates, the entire stock market reacts. If rates go up, borrowing money becomes more expensive for companies and consumers. This can slow down the economy, and stocks tend to fall. If rates go down, borrowing becomes cheaper, which encourages businesses to expand and consumers to spend. This usually boosts the economy, and stocks tend to rise. That's why every time the chairman of the Fed gives a speech, all of Wall Street holds its breath and listens to every single word. Now let's talk about the goal of all this: making money. There are two main ways people earn a return from stocks. The first is through capital gains. This is the classic buy low, sell high strategy. You buy a stock at one price, and if its value increases, you sell it for a profit. The second way is through dividends. Dividends are small, regular payments that some companies give to their shareholders. Think of it as your share of the company's profits, a little thank you for being an owner. Smart, long-term investors don't just trade randomly. They research and buy shares in good, solid companies and hold on to them for years, even decades. This strategy is called long-term investing. Let me give you an example of its power. If you had invested just $1,000 in Apple back in 2003 and held on today, that investment would be worth over $300,000. That's the incredible power of letting your money grow over time. On the other hand, short-term traders try to profit from small price changes every day, buying and selling constantly. Some win, but studies show that most actually lose money over time. Why? Because trying to perfectly time the market, guessing the exact top and bottom, is nearly impossible. So here's the ultimate truth about the stock market, the one thing most people don't realize. The U.S. stock market isn't just about numbers, charts, and financial reports. At its core, it's about belief. It's a massive global system built on human psychology. When investors believe the economy will grow and companies will succeed, they buy stocks, and their collective confidence pushes prices up. When fear and uncertainty spread, they sell, and their collective panic causes prices to crash. In a way, the stock market is a mirror reflecting our collective hopes and fears about the future. This is exactly why one of the most successful investors in history, Warren Buffett, has a famous saying: "Be fearful when others are greedy, and greedy when others are fearful." He understood that the market is driven by emotion, and the biggest opportunities often come when everyone else is panicking. So now you know. The U.S. stock market isn't some mysterious, unknowable machine. It's a living, breathing system built on ownership, supply, and demand, human emotion, and trillions of dollars changing hands every single day. The next time you hear someone say, "the market is up," you'll know exactly what that means. It means that, on that day, hope and confidence won out over fear. If you found this video helpful and want to learn more about building wealth, make sure to hit that like button, subscribe to the channel, and ring the notification bell. In our next video, we're going to reveal how millionaires actually invest their money, and the strategies they use are probably not what you think. Thanks for watching, stay tuned, and invest smart.